Appreciate everyone joining in today. So for those of you who don't know me, my name is Josh Bennett. I'm part of our investment team here at LifeWorks, as well as part of our tax team, which both will be sort of relevant to today's conversation. Ron, unfortunately, had a conflict today, so he'll be here just for me today, which we'll try to keep it fun. But if you have any questions kind of along the way, since I'm sort of running this show solo today, put any questions in chat. I'll try to pause and answer any questions that you have along the way. Also, we'll leave time at the end to ask any questions and make sure we go get through anything that you have that you're wanting to get answered. Otherwise, we'll go ahead and dive in. And everyone can see the screen, correct? Can you give me another thumbs up or? All right, perfect. All right, so. Couple things we're going to talk about today. As always with these investment conversations and market updates, we're going to talk about the economy and just give an update on the status of the economy, an update on the markets and just how the markets are doing right now. Something that's a little bit new, but something that we think is super important, and we want to start doing more ongoing, is having a little bit of an education spend when it comes to the markets and the economy, just so that you're learning about more than just what's going on. Why it's more about why these things matter. So have a section on the last part that's going to be on a topic we're going to talk about modern portfolio theory and what it is and why it's important today. If you want to say just for the market stuff, that's totally fine. No one will judge you, but I think it'd be super valuable for you to get a little bit of insights on that. Anyways, we're going to talk through the economy. So. First place I wanted to kick off was talking through the humbly named Big Beautiful Tax Bill. So if you're not aware, Trump recently issued kind of the first rough draft of the proposed tax bill, and there's a lot of interesting things in there that I think will have some either short-term or long-term ramifications on the economy as well, but also they'll have some short-term and long-term ramifications on your tax bill, depending on what ultimately goes through, right? So, as we all know, with any legislation, it goes through several iterations before it actually gets released, if it gets released. But a lot of these, especially with Republican Congress, Republican president, like a lot of this is expected to get pushed through in some similar capacity. But what's in that bill is, so there's some updates to the standard deduction, nothing too dramatic, but basically the standard deduction is going to get increased by about $2,000 for joint filers, $1,500 for head of household, and $1,000 for any other single filers. The other thing that is very relevant to a lot of people, especially if you're on one of the coasts where real estate's extremely expensive, the cap on mortgage interest. So that is going to continue and actually likely be made permanent. So that's, if you're in California especially, or New York, that's something to really keep a close eye on. The other thing that impacts especially the East and West Coast quite a bit more than in the Midwest is the SALT deduction, so the state and local tax. So there has been a $10,000 cap on state and local taxes. A lot of folks in the Midwest may not be as impacted by this, but definitely, again, hits those East and West Coasters. You're getting a little bit of a reprieve potentially with this act, where that SALT cap should go up to $30,000 for joint filers, which would again have a pretty large impact for those coastal areas. However, it's supposed to eventually phase back to $10,000 unless it's changed again and made permanent. There's going to be new tax exemptions coming out. The big one that's got a lot of news is no tax on tips, and as long as it's sort of a approved industry where tipping is common now. I know you may be thinking to yourself that these days there's a tip question at every single thing you ever swipe your card for. But they're sort of leaving that towards like restaurants and things that historically have been tipping based economy. Same with like overtime. Now there's going to be exemption on taxes with overtime. He has not proposed in this bill a complete elimination of taxes on Social Security, which was one of the big campaign promises and thing a lot of seniors are hoping for / expecting. But there is going to be, as of right now, an increased standard deduction for those above age 65, which is better than nothing, but still not necessarily the elimination of the tax on Social Security that we're all hoping for. Again, these things could change. I mean, what we'll see is pushback. Always can happen on these things, and based on what voters are pushing for, you may see some of these things get amended. Other big things that are in this tax bill that could have a pretty dramatic impact: estate tax provisions. So right now, the exemption is $15 million. It's looking like that's going to be made permanent. If you're not familiar with kind of what that means, as I've seen a lot of people, that's sort of a new concept that a lot of people get it in general. But basically, what the estate tax exemption means is every United States citizen is allowed to pass along gifts and through either life or death, right? So if you pass it through death, it's an inheritance. If you pass it through life, it's a gift. They're basically the same tax code, right? It doesn't necessarily matter when you pass that money, but if you pass it, it accounts for as part of your estate tax rules. So what this is essentially saying is every American can pass along up to $15 million estate tax free throughout their life. So if each year you have, I forget the exact what it is this year, I think it's 18,000, but each year you're able to pass a certain amount without triggering, these exemptions. But if you, like, for example, say this year gave, a family member a down payment on a house for $200,000, that would eat away at a portion of your $15 million exemption. And then if you passed away, you would only be able to pass along 14.8 million. So that's essentially how it works. But it's been 15 million, but it's in our lifetime, it's been everywhere from 0 to 15. So this is typically one that's commonly changed. So it's a pretty big step to make it permanent. Another big one that's going to affect a lot of families is green energy. So a lot of folks have been, based on past legislation with energy efficient home improvements, buying electric vehicles, a lot of those things are getting repealed. It's unclear whether those will still be in effect for the remainder of 2025. But so this is something to keep a close eye on, especially if you're doing any renovations to your houses, plan on buying any electric vehicles, or already have done these things. Just to make sure you're getting your credits if applicable, or if it's something that's really close on your roadmap, it may be worth, if it is going to sunset after 2025 but still be effective for 2025, it definitely may be something you want to push through just to make sure you get those credits before they disappear. Another big one is business depreciation. So for those of you who may not be aware, like if you're not a business owner, a big thing that was in the original Tax Cut and Jobs Act was this concept called bonus depreciation, which basically allowed you to buy equipment and things like that and take a expense against that piece of equipment all in 1 year, where typically you would have to divide it in anywhere from, say 1 or 2 years up to like 40 years. So this is a big thing that will definitely have an impact on a lot of business owners. And this is, I'd say, one of the more positive things that we've seen from the original Tax Cut and Jobs Act, especially when it comes to business owners. So that one's actually, I think, fairly exciting. Research and development credit. So this was one that was actually used to be a very powerful credit for business owners, where, if you were investing through your business into, the most common ones like software development, but if you're investing into processes, procedures, innovation of any kind, you used to be able to get a credit, which is a dollar for dollar reduction in taxes for those things that you were spending, on innovation. It got really diluted over the past couple of years, but so the idea here is to reinstate that to really, incentivize innovation in the U.S. Qualified business income tax deduction. This is another big one, sort of just incentivizing business ownership. This qualified business, it allows you to get basically 20% deduction. Historically, they're bumping it up to 22%. This is basically for Schedule C business owners for the primary person that would get this, and that's basically your sole proprietors, so small business owners. So this is sort of incentivizing small business ownership in our country. So again, that one I think is a fairly positive one. But what's the impact of all these things? So now that we've kind of gone through, some of the main highlights of this, obviously there's some pretty significant tax cuts in terms of revenue. I forget the exact numbers, but I think I saw that it was going to cut about essentially $4 trillion or $4.5 trillion in. Actually, I did put it in here. So it's going to cut it to basically cut 4.1% of revenue from taxes. To give you an idea, the government right now from taxes makes about 6 to 7 trillion a year. So it's going to cut a huge chunk of our tax revenue. So this is where you see the rhetoric in the political sphere about using things like tariffs and stuff to offset this revenue decrease from taxes to Americans, right? So, and I'm going to go through kind of like how they're going to boost the revenue here in a second, but to kind of compensate for that or what the plan is. But the big impact here is it's going, the estimations are that it's going to actually increase our deficit. So one estimation is that it's going to increase our deficit by 3.8 trillion through 2020 or 2034, which is about the equivalent of 1.1% of our gross domestic product. Others go all the way up to 5.3 trillion. And the expectation is that it will have some increased benefits for long run GDP of about 0.6%. So you are getting some of that offset in terms of just, tax savings going back into the economy to buy things, as well as, one of the expectations is that some of that tax savings goes back, especially with like things like R&D credits, and some of those go back into reinvesting into labor, right? So they're expecting to see more full-time equivalent jobs opening because of this. So on the plus side, like it theoretically should allow for more money going to Americans to be spent into our economy to boost the economy. Downside is a lot less revenue for the government, and the government then has to make up that money from somewhere, because as we generally all seen, they're not going to cut their spending, so therefore we have to get revenue to pay for the spending somewhere. So one of the ways that they're planning on getting that revenue is through the tariffs and sort of retaliatory corporate taxes. Others through ACA exchange subsidies. So basically, right now we're covering a lot of things for non-citizens in the U.S. Those things would go away. Same with like raising revenue in other areas. Like one big one that's been in the news a lot lately is things like endowments have historically been non-taxable. Now they've been treated as nonprofits. Something like that is expected to go away. So the big one in the news recently was Harvard and Yale and Columbia. They were talking about taxing those endowments. I mean, those endowments alone are, tens and tens of billions of dollars. So that's one place. Those are a couple places that they're expecting to get more tax revenue, but ultimately, whether these things make up for the spending or the revenue deficits, only time will tell. In the meantime, like our actual expenses are not exactly predicted to change anytime soon. So we have to make up that money somewhere. And what that means is we are going to have more debt in our country, which we already have a problem with having debt in our country. We've had, growing trade deficits for years now, right? And that's been one of the big things that Trump campaigned on, and one of the big things we've been talking about in these market updates is the strain on the debt from our country already, and then the impacts. So as of this week, that's starting to come full circle. Whereas Moody's, which is a rating agency that, similar to like Standard & Poor's, it basically downgraded the U.S.'s credit rating. So similar to any of us as individuals, like we have a credit score. Well, United States debt and all countries' debt have credit scores. And basically, Moody's did the equivalent of knocking it from like an 800 credit score down to a 700 credit score. And their sort of justification of that, and the reason they did that, aside from just the amount of debt we have, is they essentially downgraded it one notch of 21. And basically what they were saying is that the levels of debt that we have and strain that we have compared to similar economies in the world, we are rated higher overall despite having significantly higher debt compared to similar other countries. So basically what this is doing is evening the playing field a bit. Whereas, we've gotten away with having a higher credit rating just because we were the US and we were the dominant currency and the dominant economy in the world. Essentially that's changing that sentiment of us being the dominant economy with all the tariffs, with just changing global politics, changing everything right now. We essentially no longer have the idea of just being having good credit because we're the US. Now we're being ranked more equivalently across the world. So this has a pretty large impact on the bond market for pretty obvious reasons. So like if you're believed to have worse credit, your bonds are going to require a premium. So for example, if say I'm the United States government, if I want to go borrow money, but I'm a riskier bet, then I need to pay my investors more money for taking more of a risky bet. That's essentially what's happening. We've seen essentially treasury rates and treasury yields, jump up as all this has been happening. And that's basically a manifestation of exactly that. The risk of owning United States debt has slightly increased, even if just, on paper, it has increased. And so we're seeing that transpire into things like mortgage rates, bond rates, all these different things. And this also has a pretty dramatic effect on modern portfolio theory allocations, which is part of why I thought it'd be interesting to kind of talk about how modern portfolio theory works and how this really impacts it. But this has a huge impact on that kind of stock bond relationship and how it offsets risk. But this is something that we're seeing right now, and I would expect that rates and yields on bonds continue to go up for the foreseeable future. Also, what's happened recently, which is typically a indicator of potential recession, is what's called the inverted yield curve. And so what that is, and you can kind of see it here, is so you have short-term bonds and you have long-term bonds. So like this would be 30 years, and then you have 1 month, right? So the interest term debt is higher than the rate on some mid-term debt and some long-term debt, right? So what that basically means is the short-term future seems much more unpredictable and risky than the sort of mid to long-term, right? So again, that kind of is used as a quasi predictor of recessions because they think that obviously short-term risk is drastically increasing. So this is something that is definitely worth keeping an eye on as well. It's just what's happening in the short-term bond markets. And I showed this slide in our update, like I think 2 months ago, but I think it's worth bringing up again and kind of why this impacts and also goes into that modern portfolio theory conversation. So when we think of historically the way people invest, and kind of what you hear in a lot of retail finance is the idea of have a 60-40 portfolio, 60% stocks, 40% bonds, and when stocks go up, bonds slow down the growth a little bit, but when stocks go down, there's your risk hedge, right? So historically, the idea is that you have these two, not having your eggs in one basket to sort of offset that risk, and you can kind of control your returns over time for the level of risk you're willing to take. And we'll go again more into that here in a little bit, but that idea doesn't always hold up, and we're kind of seeing this in the markets right now, especially this week. And we also saw it again in April. But basically, what was happening was that on a day where the stock market really took a hit, there was volatility in both assets, both the stock market and the bond market, which so sort of defeats the idea of having bonds in your portfolio as a risk hedge. So this is something to, again, really keep an eye on, because bonds historically have gone through time periods where they do not act in the way that they should. And I think we're in the middle of that right now. And we're really starting to see the actual impacts of that. So I no longer necessarily view bonds as what would be considered a safe investment. They have risk to them, just like anything else. Probably significantly less risk than stock markets or other more volatile assets, but they have risk nonetheless. And that risk, with everything that's going on from a global politics and economy perspective, is worth paying attention to. The other thing I thought was really interesting in our economy as of late, with all the stuff going on with like our credit ratings and just the bond markets in general, we've seen a lot more volatility in gold, which gold is, you can kind of see here, it's like in this, there's the high, and the blue is the high, and then the yellow is the low, and then what it closes at. So typically, you should see these trading pretty close together, like they have been earlier in the year. But then, as of May, it starts going haywire with all the tariffs, all the debt, credit ratings, all those things. So we've seen a pretty drastic increase in volatility in the price of gold, which to me again is a bit of a canary in the coal mine of just a lot of uncertainty and volatility in the economy, especially with tariffs being enacted, tariffs being repealed, all these different things. So again, this just kind of tells us that it's a time to be very cautious and with your investments, and be very methodical with how you're doing your investments and making sure they're really tied to your plan and really thought through in a cohesive fashion. Similarly to gold, the theory with Bitcoin is it has a lot of similarities to gold in terms of the appeal of it, where it's an asset that can't be inflated. There's only a fixed amount of Bitcoin that will ever be created. Same with like gold, like you're only going to be able to dig so much out of the ground. And so that's been one of the appeals of Bitcoin. Historically, we haven't seen much of that in reality in terms of how it's actually functioned in terms of the price compared to the economy. However, we are seeing it act more similarly to gold as of lately, just because of the global uncertainty. I think people are starting to view it more as a safe asset class when it comes to especially currency related controversies. The other thing that's been really impactful for Bitcoin recently is in I guess the world of like cryptocurrencies, is that Congress recently started pushing a bill through to have some regulations around stable coins, which, if you're not familiar with stable coins, they're basically a way of pegging a cryptocurrency to another, like a actual currency similar to like the US dollar. Historically, these have been wildly unregulated, but they are starting to have some regulations around that, which a lot of cryptocurrency investors sort of view that as a step in the right direction to having more legitimacy around these type of investments. So as we see more legitimacy from a regulation standpoint, our expectation is that we will see more similarity to like gold or like the those type of asset classes that again provide sort of a non-correlated opportunity compared to, say, the stock market, where like bonds would traditionally play that part. So like things like Bitcoin and gold are going to have the opportunity to sort of step in and be, when stocks go up, crypto might go down and vice versa. So sort of be that non-correlated asset. Anyways, that kind of leads us into the rest of the markets. So we have the equity markets. So a couple of things I think are really worth talking about here. So overall, year to date, markets, like the stock markets, are mostly flat as of now. So we did see, the pretty major crash in March and April around the tariffs. We've seen quite a bit of a recovery since then. Like the S&P 500 is up 1% for the year. I mean, not gangbusters return, but better than zero or better than negative. The Russell 2000, which is basically includes a lot more of the smaller cap companies. Those haven't recovered quite as well, but have recovered quite a bit. The interesting thing of note here, I'd say, is what's been happening globally. So we have seen global markets kind of on a tear this year. And they've definitely done a lot better in the face of the tariffs and sort of political instability than the U.S. markets have, which has driven a lot of people to be asking us questions around, why we don't invest in a lot of global stocks. And there's a reason. And you will have times like this where, global stocks do outperform the U.S. equity markets. Like that is totally to be expected. However, like the reason we don't, and I'll kind of show this in a second, is that's a small gap of time, right? So historically, non-U.S. markets have not done anywhere near as well as U.S. markets. And one thing we're seeing is that when you have similarities, like during market crashes, as well as just overall, like there's been a pretty strong correlation between the U.S. markets and international markets. So, AKA in terms of risk, U.S. markets and international markets are about the same. So you're essentially taking the same amount of equity risk, whether you're in the U.S. or international. But you haven't been getting compensated for investing in the international markets for that risk the way you have in the U.S. So to kind of show that and highlight it, here's the long-term kind of view of the different markets. So you have the NASDAQ, which includes a lot of the tech companies, like primarily the tech companies. You have the S&P 500. You have the Russell 2000, which includes like small cap companies. And down here, this is international. So even though on the short run, we're seeing a nice pop from international, long-term, it has drastically underperformed the U.S. markets. And so that's one of the reasons like I wanted to highlight this is like, again, we get that question all the time, but you're just not getting compensated for the equity risk nearly the same way that you are getting compensated for equity risk in the U.S. markets, at least historically. And as of right now, I see no reason that's going to change in the near future. There's always going to be companies and countries that do well internationally, but the U.S. markets are just such a dominant force, and the companies within the U.S. markets are such a dominant force globally, and I don't see that changing necessarily anytime soon. Concentration risk. So this is something that still is a big thing, though, in the United States. So we've talked about this a couple times, but I think it's worth re-highlighting. So right now, the S&P 500 is still incredibly concentrated. So about 7 to 10 companies make up the vast majority of the total market cap of the S&P 500. So there's a significant market risk in what we call like the Mag 7. What that also means is that those companies have some pretty extremely high valuations that are much more subject to expectations, speculation, and growth based on speculation and expectations isn't very sustainable. So we saw this recently with NVIDIA, where NVIDIA basically crashed 20%, even though it was like a $3 trillion company, it crashed like 20% in a day. That just shouldn't happen with companies. But when expectations all of a sudden change like that, like they did with NVIDIA, where China put one news article out saying that DeepSeek, their version of AI or their version of ChatGPT, didn't rely on the type of GPUs that essentially power normal AI. So the expectations of growth changed, and all of a sudden, boom, a huge change in the S&P 500 as well as the NVIDIA stock. And we also saw that that's one of the big drivers of what happened during the tariff crisis was companies like Apple or some of the main components of the S&P 500 rely on China a lot. And so a pretty heavy trade war had a big impact on the speculations of Apple's future growth and therefore caused turmoil in the stock price. So this is something that's still a real thing. And to highlight that, I wanted to kind of show the performance of them separated out. So like if you look at the S&P 500 for the year, so we have all 500 companies. This is this kind of black line. So this is all 500 companies. Whereas if you look at just the top seven companies are down almost about 15%, right? Whereas like the S&P 500 is up 1%. The other 493 companies are up, just over break even. And these actually are up higher, but we just didn't have all the data except till the start of May. So anyway, so like this kind of highlights that it's been not the big name companies that have been really driving the recovery of the S&P 500. It's been the small name companies that just didn't go down as much during the crash. This one thing we've been kind of preaching through these market updates is like, this is why we invest the way we do, is we're picking the more financially stable, less speculative companies in the S&P 500 to invest in. And that's what keeps portfolios more stable and therefore more predictable from a financial planning standpoint long term, is investing in things that aren't speculation and aren't as subject to these kind of downturns, and are more subject to these kind of recoveries. So concentration risk in the S&P 500 is still a big deal. I think it's going to be for the foreseeable future until we see a fairly large correction on those top 10 companies, which, I mean, we've seen bits and pieces of them, but like NVIDIA has recovered significantly. A lot of these companies have already popped back, even though they're still holistically down quite a bit. They're still some of the 10 largest companies in history. So they'll have to go down significantly more to, I think, really have an impact on the S&P 500 not being concentrated, if that makes sense. Okay, so looks like Isaiah asked a question. 1 second. What would be considered a high concentration in a portfolio that has 50 stocks versus 500 stocks? Is there a rule of thumb here? So, great question, Isaiah. So, like, yes, there is a rule of thumb. So when you look at like the benefits from concentration versus diversification, I can't remember the exact study that showed this, but basically you have essentially a diminishing marginal returns on diversification. So essentially between 10 stocks and 25 stocks, you see this exponential increase in the amount of benefit you get from adding that next stock in terms of diversifying. So sort of the minimum that you should have would be like, exposure to 10 stocks, for example. 25 is kind of the sweet spot where after 25, you don't get significantly more marginal benefit of adding the next stock to your portfolio. It can always be beneficial too, but like at some point, for example, like what will start to happen, like we typically have anywhere from 25 to 50 stocks in the portfolio. Much beyond, say, 50 stocks, you start to see getting closer and closer and closer to being very correlated to the S&P 500, because you start getting companies that are the main driver. And then, obviously, once you have 500 companies, you're exactly correlated to them. So, kind of the minimum I'd say you would want, or I guess like the maximum would probably be like 10% concentration to one individual company. That's kind of like a typical rule of thumb. So like, let's say you had 10 stocks at 10%. That being said, like there's times where concentration can be beneficial. I mean, people like Warren Buffett and investors like that are an example of this. But that being said, going much more concentrated than say 10% of your portfolio, especially if you don't have control over the outcome of that company, can be an extremely risky endeavor, because that's where the performance of that one company really drives your overall risk and return of your portfolio. Hopefully that kind of answers that question. But yeah, say rule of thumb would be like max of 10% of any one company in a portfolio. All right. I'll pause before I kind of dive into the education piece. I'll pause there and see anybody else have any questions that they want to dive through on any of the economy or investment topics. Feel free to like unmute your mic too if you don't want to type it. Anyone? Anyone? All right. So it looks like Richard. All right, Richard. I think I unmuted your mic. Maybe. Richard, are you able to? Let's see here. So I'm not the most tech savvy with this platform, so you have to bear with me. Richard, are you able to ask the question or still having trouble with the mic? Yeah, maybe, yeah. Trevor just put that maybe accidentally. Richard, if you have a question, can you just like put a thumbs up in the chat, and we'll try to get it answered. Otherwise, we'll progress on. All right. So, kind of talking through the education piece. So, modern portfolio theory. So, we kind of alluded to what it is earlier in the conversation, but basically, modern portfolio theory was created back in the 1950s by a guy named Harry Markowitz. So he ended up actually winning the Nobel Prize in economics for this research, and so it's sort of the backbone of a lot of modern retail financial practices. So I mean, I'm sure you guys have heard, the ideas of, don't put all your eggs in one basket, diversification, moderately aggressive portfolio. All of those things kind of originally came from modern portfolio theory. And the idea here, as you can kind of see it from this diagram, is it's essentially a way of choosing asset classes to balance out risk and return. So like if you wanted more return, you have to take more risk. And that, it has this what's called efficient frontier, which the idea is like, okay, as you take more risk, you can get more return. But you want to be on kind of that sweet spot of like not taking too much risk without the return, or like getting too much return without any risk also is typically something wrong. And so you want to be like, the goal with like a modern portfolio theory portfolio is to essentially land on this like efficient frontier, essentially. And what it's really trying to do is control that risk and return ratio. Works really well in a vacuum, and especially in academia. Like the concepts are very sound, and there's a lot of really good things that came from this idea of modern portfolio theory. But a couple things to point out as we go through this is like a lot has changed in our world and our economy since 1952 when this was originally created. Whereas like things like international stocks weren't as common. I mean, we're coming out of 1945 and World War II. So there wasn't a huge, globalized economy at that point. Whereas these days, like you don't necessarily get much diversification from owning international when you have companies in the U.S. stock market like McDonald's, where 50% of its revenues are in the U.S. and the rest is all international. And there's exposure to currencies and all these different things. So you're getting a lot of your international diversification even just by owning U.S. stocks. So it's an idea that worked really well at the time, especially in academia. And one of the main kind of poster child, portfolios that kind of came out of this was the 60-40 stock bond portfolio. So you have 60% of your portfolio in stocks, 40% of your portfolio in bonds. And the idea was this was like a balanced or moderate portfolio. One of the other big things that came out of it was, you may have heard us, talk about risk scores. Like this is a big thing with a lot of financial advisors of like, what's your risk score? lot of this came from modern portfolio theory with like being able to identify or try to identify the risk return ratios. Again, this works really well in academia, but what we've seen in real life, it doesn't, or at least only works for certain periods of time. So what this diagram is, and I think this is really interesting, is the correlation between stocks and bonds over time. So the blue line is basically a smoothed out version of essentially a 10-year correlation between the two different asset classes. So you can see there's times where like they're all over the place. Like sometimes they move in the same direction, sometimes they move in opposite directions, sometimes they move together. So the closer you get, like one, if you're not familiar with how correlation works, one is basically they move exactly in tandem, right? Negative one would be they move exactly opposite. So as you have the spectrum, you can see they're like sometimes moving together, somewhat, sometimes they're moving in opposite directions. So over time, their interactions really differ. And this pink line over here is the shorter term volatility of correlation. And you can see that especially during times of volatility, that increases pretty drastically. So like even on like a short term, it can be very unpredictable in terms of how those two asset classes or asset classes in general are going to interact with each other. So you're not necessarily getting the risk diversification that you should be getting under kind of the academic rules. Okay, so all right, thanks, Richard. Sorry, we couldn't get that mic working. Looks like he posted the question. With the change in bonds due to credit downgrade, how does that change our short-term holdings? So as of right now, it won't change, and that's part of why. And I'll get into this in a second. That's part of why we have the different tranches, and why we believe in like a different tranche system is like you're always going to have some sort of risk in a bond portfolio, even though it's significantly less risk than in a stock portfolio. One of the things that we're trying to prevent is having you rely on an asset class for either hedging or for a short-term need if it's not in a stage of reliability. And that's why we sort of, have the sort of a cash allocation, then go more towards like bonds and those type of parts of the portfolio in our tranche 2 is basically for this reason. So like, because you're going to have some volatility in the bond markets always. That's just something that we can't get rid of. But the idea is it's typically less volatility than you would get in a stock market. And so that's one of the components that helps, sort of reinvest into your short-term cash flow. So it's something that is always going to be there. And that's part of why we keep some separation between bond allocation and then what you need in terms of cash flow, if that makes sense. But yeah, diving back in here. So another part of modern portfolio theory that has not sustained over time is times of crisis. So one, the correlations over time don't always, work in the way that they're supposed to, and hedge risk the way they're supposed to. But especially during times of, trauma or market collapses or anything like that, what we see is a conversion of asset classes around those times. So, for example, during 2008, it wasn't just the U.S. stock market that went down, right? We had S&P 500, we had world stock markets, all these different things were going down at the same exact time. So there was a heavy correlation amongst asset classes that were supposed to be diversified. And I can't remember the exact number, but I think like U.S. and international stocks got to pretty much like 99% correlated. Meaning they basically kind of, again, on that 1 to -1 scale, they were basically moving in tandem. And we even saw that with like other things that are not even stock related. So for example, I don't know if you can read this, it's kind of small on here, but like commodities. So commodities are, gold, oil, grain, those sorts of things. Those are all commodities. So this is this gray area here is 2008 recession, but you can see the spike down in both international stocks, U.S. stocks, as well as commodities. So that's commodities are historically considered a non-correlated asset or a hedge on a portfolio. It did not serve as one during that market collapse. Same with even gold during the 2020 or 2020 crash with COVID. We also saw, so this blue line is gold. So we saw gold crash down with the stock markets as well. So the idea of modern portfolio theory is you use these different asset classes to offset risk, and that's your only risk hedge, is that you just have a different asset class in the portfolio that theoretically should be zigging while you're zagging, right? Or, gold should be going up while stocks should be going down, right? That's the theory. But relying on that as a risk hedge, as you can see in kind of real life, doesn't necessarily work out the way it always is intended. Just because when you put humans in the mix, there's greed, there's fear, there's a lot of irrational emotions that get into the markets. And that's what drives a lot of these discrepancies is in times of, bad markets, people just get scared. And it's not necessarily that they're, moving to safer assets. They may just be getting out of the market and going to cash or putting it on their mattress. There's just things that people do that sort of defy logic that have an impact on everybody else's portfolio. So kind of thinking through and in summary of modern portfolio theory, there were a lot of really good things that did come out of it that we use at LifeWorks. We use that are just really good life wisdom, don't put all your eggs in one basket. That concept from modern portfolio theory, I think, in diversification, I think still are huge parts of what we should be doing as financial advisors, and what you as investors should be doing is spreading out your risk. We obviously are big believers in doing it amongst companies, as well as through our tranche system. But yeah, you should definitely not be putting all your eggs in one basket or having essentially a concentrated risk in your portfolio. That is just over the long term, again, real life variables just don't provide the risk to reward ratios that you would otherwise want. And again, that's why we're big believers in kind of this tranche system. This is the best way we've discovered, and there's Nobel Prizes and things like that to back this kind of logic. But this is why you need an extra layer of hedging, especially coming into uncertain times, to apply to your portfolio. So you have your safe assets, which is basically cash, CDs, or cash equivalents. Then that's where you start to get into income, mostly bonds, some dividends, things like that, and then growth. And the reason you have this is because of volatility, you need buffers to provide you a barrier between this volatility and this risk. And then that way the cash and everything can flow down to become a safe asset over time. But not having this kind of layer just makes you susceptible to the ups and downs of the markets. And if you're relying on a hedge that could collapse at any moment, we don't view that as a very predictable way to invest for things like retirement or for any goals in your financial life. So really having a strategy, if you aren't having ongoing conversations with your advisor about this, really having a strategy that ties into why how our investments are funding our goals and how we're protected from that risk. I think that's something that you should definitely be doing, and it's something that's critically important. But with that kind of ties up the scheduled program, if you will. But I'll pause there and sort of open it to the floor. I mean, we got 10 minutes to the top of the hour, and then I can say longer if anyone has questions that we want to talk through. And I'll see if I can figure out how to turn the mics on. But otherwise, there should be a little chat box down in the black bar feel free to type your questions in as I'm trying to figure out how to open up everybody's mics. Anyone have any questions? Okay. Is the deficit sustainable with the suggested budget? None of the income suggested is reliable. That is a great question, Richard. So my honest opinion is no, that it's not sustainable. Um, ultimately we'll see. I mean, I have sort of a, thesis that we'll have the, tax cuts and stuff that are implemented. And I think we'll start to see the realities of not having that revenue in the door, because with the credit ratings that we've seen, the credit rating changes, like there's less of a demand globally for U.S. Treasuries. And if there's less of a demand for U.S. Treasuries globally, one of two things will happen. Either one, we won't be able to raise the capital we need to fund these deficit spendings, or two, we're going to have to pay more in terms of the yield to get the money in the door to pay our deficit. Either of those things is not great, especially if we have high interest rate that we're having to pay. Like that's a big struggle that is already happening in our country, whereas like just the amount that we have to pay in interest on the debt is almost as high as like how much money we make in terms of revenue each year from taxes. And so that's going to be something that's going to be just get exacerbated over and over. I mean, there's been a lot of sort of creative strategies about how to get around that, like the $1 trillion coin and just printing the unlimited money button through the Fed and things like that. No one really has any idea other than philosophically what the actual impacts would be of those in a real world situation. So I think what's going to happen is that we're going to start to see the painful impacts of all the tax cuts, lack of revenue, and my sincere hope is that sort of reins in the spending a little bit at the government level just because of that pain. But ultimately, who knows? Everyone here knows how, not to get political, but everyone knows how politicians typically go. So who knows what'll actually happen in that, but I don't think it's sustainable. And I think something will have to give. Just who knows when it is. Henry asked, anything further on tariff impacts, or is it still too early? I'd say it's still too early, especially like right now. I mean, I think the biggest impacts that we're seeing like countries come back to the negotiation table. I mean, as of this week, like China did announce that they're feeling the impacts on their economy from even just the short-term trade war. So it could bode well for better negotiations in terms of, instead of escalations, in terms of coming to a middle ground between what they want and what we want. So just like some other countries have already come back to the negotiation table to try and, again, come to some sort of middle ground with what President Trump is wanting to see in terms of the deficits versus, what's doable. I mean, I don't think we're ever going to get to the point where, we've eliminated a deficit with every country. Like, was being proposed. But I do think we can come to some sort of middle ground and get revenue back in the door. And it seems like are some steps that could happen here, just especially with like China feeling the pain a little bit. So a lot of it's too early to tell, but at least seems like the negotiations are taking place, and hopefully it does end positively instead of escalation. I think escalation would be the thing we want to avoid. Okay, Richard, it seems like. Yeah, so Richard said that it seems like Social Security is something that nobody wants to address. Is there anything occurring to address the issue? Seems like this would help the deficit. So, yeah, to your point, you are exactly right. The Social Security programs are one of the big drivers of the deficit, but like I forget the exact numbers, but as of right now, the numbers supporting Social Security are not good. I think the expectation is that the current Social Security trust is going to be bankrupt sometime in, I think it's like 2030, 2035, something like that. Like not too far away. And I think Medicare bucket might be even sooner than that. But there's also like, I think it's probably up to like $100 trillion of unfunded liabilities when it comes to Social Security. And just to put that in perspective, like I think our average tax revenues each year before these tax cuts was about 7 trillion, like I mentioned. So if you think of 100 trillion of unfunded liabilities, that's a big gap. So nothing's really being done that I've seen to address that. And I think the primary driver of it, from what I've seen, is that it's essentially political suicide to bring up any sort of cuts or changes to Social Security, because so much of our country relies on Social Security, whereas that is the retirement plan for, I think it's like 70% or more of our country. Like that's their main source of income in retirement. So making change to that would be pretty catastrophic to a lot of Americans and aka a lot of voters. So it's something that needs to change. But it probably won't change until, again, we're forced into a painful situation that forces everybody's hand. So we'll see. Okay, so Ron appears to be right that politicians aren't serious about cutting spending. Yeah, I would never tell Ron he's right to his face, but it does not seem like any politician's serious about cutting spending. And again, it's, I think, almost in a lot of cases political suicide to cut spending the way places like it needs to be cut. Like the main drivers of our deficit and our budget are military spending, Social Security, and things like that, which are heavily supported voter programs. And so if you start seeing those changes, it's essentially politicians voting to get themselves kicked out of the office, which, if we know anything about politicians, they're going to be looking out for number one. So chances of them voting themselves out of office is pretty slim to none. So I do think we're going to be in a situation where these deficits are going to get exacerbated, and ultimately decisions will get forced one way or another. But yeah, I don't think they're going to get serious about cutting spending anytime soon. Maybe I could be wrong, but I don't think so. Okay, Thad, I may have missed it, but what percentage range of total investable assets are you recommending in Bitcoin? Not a lot. So Thad had asked how much we recommend investing in Bitcoin. I think our allocation of gold and Bitcoin is like right now about 2.5%. So again, depends on kind of like the strategy, but it's pretty low. There's been some studies that have essentially shown like the threshold for where Bitcoin has kind of a really good, thanks Trevor. Okay. Yeah. So 5%. So 2.5% for gold and 2.5% for Actually, yeah, I can't remember. 2.5 for Bitcoin or 5%. Anyways, anywhere I think it's around 2.5% is the primary for Bitcoin. But there's been some studies that have shown for Bitcoin like where the like sweet spot is in terms of like risk adjusted rewards for Bitcoin. It's like obviously Bitcoin has been a really good asset class in terms of growth, but as everyone has seen, it's insanely volatile and creates a lot more risk in a portfolio than the average retiree doesn't like to see their portfolio crash 80% overnight. So there's definitely a fine line where like adds more benefits than it takes away in terms of like a volatility perspective, and that range is basically kind of that 2 to 5% range is where it adds benefits from a risk return ratio. Much after that, similar to like the conversation around concentration we were talking about earlier, once you start getting too heavy of a concentration of Bitcoin, because it is so much more volatile than a typical like stock, even a small bit of concentration of Bitcoin can add tremendous like risk to the portfolio in terms of at least volatility risk. So I personally would not recommend more than 5 unless you are comfortable with a wild ride. But what other questions they may have? Okay, so Trevor just posted. So our allocation right now is 1.5-ish% Bitcoin and looks like about 3.5% gold right now. Okay, so Gerald put, to what extent deficit spending pumps fuel into our economy if we eliminate deficit? Good question, Gerald. So essentially, what summarizing kind of what Gerald's asking here is, in a way, basically having this debt and this money that comes into our economy and having this deficit essentially pumps fuel into our economy that fuels growth. And if we take away some of that fuel, how can we keep growing without a recession or a major crash, things like that. So there's a lot of layers to it. So like this is where you kind of get into a lot of economic theory as opposed to like what happens in practicality, because a lot of these things like no one really knows to a complete extent. Like if you pull one lever, what happens, right? So what we've seen historically is, and like it's like one school of thought is that we can basically just print money into perpetuity, and as long as we have GDP growth, it's fine. That's been sort of the basis of modern monetary policy, which is sort of garnered some waves on the Democratic Party. And that was like one of the big backers of like big components of like the Green New Deal, if I remember the name correctly. Yeah, so there are some like theories in economics that you could just keep a deficit going and going and going, and if I could just print more money and no problem, as long as we have growth. But what we've sort of seen historically is there are levels to the amount of leverage that countries and economies can have. So if you're not familiar with them, there's a guy named Ray Dalio who runs, or I guess used to run, Bridgewater, which is one of the biggest hedge funds in the world. And he was actually the guy behind, like, he used to be the guy that if the United States government had questions on economy, they went to him. Like he was one of the guys that created like strips, which are essentially a type of U.S. Treasury note. But so super smart guy in the world of economy. But he basically wrote a book recently, or has wrote several kind of on this topic. And the one that is a terrible name, but it's Principles for Surviving a Changing World Order is what it's called. But basically, he had a bunch of economic studies where he went with all the top like professors in the world when it came to history and economic history and currency history, met with all of them and tried to deduce like the cycles of history in terms of like, how countries rise, how currencies rise and become the like dominant US currency, and how they fall, right? And try to create a predictable cycle around that, right? Because even over the past 500 years, like, obviously in all of our lifetime, the US currency and US economy has been the dominant one. But in the past 500 years, there's been about 8 different world currencies, from like the British pound to the franc to the, I can't remember all of them. But so essentially what's created all these is a bubble that basically happens is like, countries grow and they're very fiscally responsible. And then what happens is as they grow and are successful, people start to experience more luxury, more, the benefits of success. And then they don't want to get rid of it. So they keep printing money or keep, inflating money to keep the music going. And then eventually the bubble bursts. And then there's a, big economic crash. And then another country takes over as the global power, right? So that cycle's been done over history. And so one of the arguments now is that we're sort of at this precipice where, we're in that stage of, printing money to try and keep the music going. And the thought is that if we keep the music going too long, that bubble is going to burst. Similar to like if you take on too much credit card debt, eventually you can't pay your bills and people lose faith in you as a creditor, et cetera. So that's kind of the expectation. And so one of the arguments for cutting spending is, yeah, it's realistically going to be very painful for our economy and there will likely be potentially very long recessions or very painful recessions to correct this economy and the spending deficits. And like that's a very real possibility. Similar to like back in the 1980s, like Paul Volcker essentially, came out and said the only way to prevent or to get rid of inflation at the time was to essentially break the economy. And that's what he ended up doing, and it ended up working, and then set us up for success for the next 50 years. Right. So we're kind of at a stage now where it's like, yeah, something has to break to bring us back to a healthy ecosystem. And so there is a real possibility again that like taking that money out of the markets would cause a recession. And it's likely to do so, but it'd be sort of the idea would be short-term pain for long-term gain. Otherwise, with leverage, what comes is higher highs and higher lows. So the idea is that, okay, if we don't do this now voluntarily, we could be subject to a much more painful, whip slap later down the line when it's no longer our choice to try and take corrective action, if that makes sense. And it's the economy or the ecosystem that's taking the corrective action for us. So long-winded way of answering your question, Gerald. I hope that gives some. But I also mentioned, would the Fed cover that through lower interest rates? They could theoretically do it through lower interest rates, but there's I guess other variables that would play into that. And if like you're cutting spending, like you're encouraging spending by cutting interest rates, so like it could theoretically stimulate the economy. But right now, and that was actually kind of the idea behind negative interest rates and stuff in Europe. Right now, we're just at a place where there's only so much lower you can go on interest rates, and that's one of the worries. And that's part of why the Fed aggressively raised interest rates. Counterintuitively, as they raised interest rates really aggressively, primarily so we had a tool to like lower them back down if we needed to. Yeah, so like the downside is like there's only so much so far down that we can go without going negative. And I do think going negative rates in the U.S. would be a lot more dangerous than it was in like Europe, just because of the global tie to the U.S. dollar. Okay, Trevor said, what do you think about the Notre Dame dome over the entire country to help cut the deficit? Nothing Notre Dame should ever be. No, I'm just kidding. Yeah, no, I got nothing. Sorry, Trevor. Any other questions? Anyone? I'll give it a minute to see if anyone's typing away. In the meantime, sorry about the technical literacy with trying to turn people's mics on, but appreciate everybody being willing to type for me. But give another minute, see if anyone has any final questions. Otherwise, we'll potentially wrap a little early. Bueller. How about this? Raise your hand on the thing if you have a question, so we know to wait. Otherwise, we'll let everyone out. All right. Okay. Gerald's got a question, so we'll wait. We'll wait. All right. Richard asks, is there a forecast for the stock market for year end of 2025? I would say realistically, no. Reason for that is, uh, I don't have a crystal ball. No one really does. If you start hearing people talk about, oh yeah, we predict the market to be X, Y, Z over the long term, realistically they're lying. Just because there's absolutely no way of, with any realm of realistic ability, to be able to predict what the market's going to do over this course of time, right? There's just, so much that can happen over any given point. I mean, what we do know is that the stock market historically goes up, 8 to 10% a year. So that would be my reasonable expectation, would be that, the market will continue to go up in 8 to 10% a year, including this year. But that being said, like this, we haven't had a true recession for the past 15 years. I mean, we had sort of micro recessions here and there, but we haven't had a true recession for quite a while. And I mean, we have a lot of global turmoil right now. Like, so who knows? Like, there could be, the recession could start tomorrow. I mean, so I'd say, unfortunately, no, there's no real prediction. But if I were, again, to guess, or I guess frame it this way, I would say, I mean, there's a lot of headwinds for growth, just based on everything that we've talked about. I would not be surprised if we end up lower at the end of the year. But we've had a lot of momentum for quite a while. So again, we also could still be higher, but I do think there's a lot of headwinds for growth in the year to come. And anything to stimulate growth is going to be wildly dependent on kind of what happens with tax code changes and tariff outcomes and all these different things. It's really too hard to say again with any certainty. So Gerald said the downside of lower ratings is the higher rates. Yep. Seems like the bigger problem is the loss of reserve currency status. Recession might solve the higher rate problem. So recession might solve the higher rate problem, but loss of reserve currency is permanent. So I mean, the loss of the reserve currency is, so kind of what Gerald thinks getting at is like, so right now the United States dollar is the global reserve currency. That's been sort of held in place for 8 decades at this point. and one of the big drivers of holding that in place has been what's called like the petrodollar, where global oil needs to be traded in the U.S. dollar. So therefore, like countries all over the world hold U.S. currency to be able to trade oil. And that's one of the big things that has created a bunch of demand for U.S. dollars globally, and one of the things stimulating the U.S. dollar. So if we lose that status, it could have pretty tremendous ramifications on our dollar, our debt, all those different things. Like one of the reasons we're able to print money the way we do now is because all over the globe, a U.S. dollar is considered a U.S. dollar, even though there's nothing backing it. And this is one of the big problems throughout history, kind of like I was saying with the cycles, is like the further and further you get away from like a gold standard or like a commonly perceived value of exchange, the less and less people potentially believe in what you say a dollar is worth. Because if you inflate it too much, people may no longer say like, man, that's not really a US dollar, or like, that's, hyperinflation, all these things have like an impact on the perception worldwide. The reason like we've been able to say like, hey, we can just print US dollars and it's US dollar is because countries are required to have that demand. So if that changes, it could have pretty drastic ramifications on our economy, our debt, all these different things. I mean, if we lose the reserve currency status, it's not permanent. It's just, these cycles historically take hundreds of years, if not decades. The quickest one would be decades usually. So it's not something that we would regain back quickly by any means. And so, that is a big risk. And honestly, I think that's one of the big motivators behind some of these tariff conversations with China, and why China was selected to be, especially punished with tariffs, is because of the push between China and a bunch of the BRIC nations over the past couple of years to get away from using the US dollar as a reserve currency. And so with that, one of the punishments was the tariff punishments was basically saying don't do it. And so, because like what was happening was like Russia, China, Brazil, India, they were starting to trade oil in, I think it was both, Chinese yuan and UAE dollars. But anyways, like, so they were trying to move away from the US dollars. And so, that could have again, a pretty drastic impact. But I mean, I think both are concerns, a recession and that happening. I think a recession's much more likely over the short term. Whereas like, nothing stays in perpetuity. Like the US dollar is not going to be the global world reserve currency for the rest of history. That's just not going to happen. So that will change at some point. But I mean, I think the more short-term concern is just making sure that, a recession is made to the point where it's like the downside of the problems are mitigated as much as possible. If that makes sense. Okay. Henry, good analogy with Volcker in the 80s. We need to tackle the deficit now, even with the recession possibility to set up future generations. Yep. It's one of those things that, we just need to, it's not going to be pleasant for anybody, but we just need to, fix our deficit one way or another, either spending or, budget. I guess, spending is the main way. We're getting more revenue, but spending cuts seems like the most, poignant thing to do. But who knows if that'll actually happen. It doesn't seem like the markets today were particularly impressed with the one big beautiful bill. I don't think so. I mean, this is where it kind of gets like the markets right now, because they're so heavily driven by just a couple companies, that tax bills actually I don't think will have that much impact on it. Really, what's going to have an impact on the market when looking at it from like a holistic perspective is going to be things like tariffs, because tariffs are going to drive impacts on those top 10 companies. So really what's going to drive the markets is things that impact tech as of right now. So if you see tariffs, if you see things like global data security rules or global, data regulations or antitrust regulations. Those are the things I think that are going to cause a immediate like turmoil in the markets, one way or another. The tax bill, I mean that's going to have some impact just from the economy, but I mean realistically, just because everyone's so focused on other things that honestly I don't even think most Americans even knew that the bill was announced this week. To be honest, but yeah, one reason the U.S. dollar is global reserve currency is the size of the U.S. economy and the amount of float in the dollar. Do you think the BRICS realistically could finance global trade? Not right now. So what Gerald's asking is like if there's enough reserve currencies and stuff from the BRIC nations to be able to fund just the amount of global trade. Right now, no, I would say not. But actually, one of the proposals was like because like a country like China couldn't float that all on their own. One of the proposals was actually using essentially a pegged basket of currencies, which I do think that's something that's entirely realistic. I mean, it's still probably challenging to implement, and that's definitely above my pay grade on how to do that. But I do think that's something that is realistic, is using more of like essentially a commodity basket to back that. Or a currency basket. I mean, not commodity basket. And that was actually one of the talks is actually even creating a cryptocurrency based on the like sort of pegged to a basket of different currencies to be the facilitator for that. But yep, thanks, Henry. What other questions you guys have? We've got about 5 minutes left. Anything? Thanks, Trevor. All right, I guess we'll call it here, and well, I appreciate everybody's attention and wonderful questions as always. And yeah, I will have this again obviously next month, and we'll look forward to seeing you guys there. Otherwise, I hope everyone has a wonderful start to their summer. Now that actually, I don't know where everyone's located in the world, but I'm in Indiana, and it's finally actually starting to get warm and nice here. So hope everyone's in the same situation as me and actually get it outside and enjoy the world. So hope everyone has a great rest of their May and a great start to June. And we'll see you here in a couple weeks. Cheers. Thanks, everybody.